Welcome to the MPC second quarter 2020 earnings call. My name is Sheila, and I will be your operator for today's call. At this time, all participants are in a listen-only mode. Later, we will conduct a question-and-answer session. Press star 1 on your touch-tone phone to enter the queue. Please note that this conference is being recorded. I will now turn the call over to Christina Kazarian. Christina, you may begin.
Welcome to Marathon Petroleum Corporation's second quarter 2020 earnings conference call. The slides that accompany this call can be found on our website at marathonpetroleum.com under the Investors tab. Joining me on the call today are Mike Hennigan, CEO, Don Templin, CFO, and other members of the executive team. We invite you to read the safe harbor statements on slide 2. We will be making forward-looking statements today. Actual results may differ. Factors that could cause actual results to differ are included there, as well as in our SEC filings. With that, I'll turn the call over to Mike.
Thanks, Christina. Good morning, everyone. Thank you for joining our call today. Yesterday, we announced an agreement to sell Speedway to 7-Eleven for $21 billion in cash, demonstrating our commitment to execute on the strategic priorities we outlined earlier this year. The sale of this business provides certainty around value realization for MPC shareholders. As I've stated before, I believe this is a return of capital business, and the substantial estimated after-tax proceeds of approximately $16.5 billion enables us to both strengthen our balance sheet and return capital to our shareholders. At the same time, the sale also creates a long-term relationship with 7-Eleven that enhances commercial performance potential through attractive fuel supply agreements and future growth opportunities. The transaction, which is subject to customary closing conditions including HSR clearance, is anticipated to close in the first quarter of 2021. If you move on to slide 4, as a follow-up to our first quarter earnings call, we're making very difficult decisions to increase profitability, create stronger through-cycle earnings, and drive long-term value creation. Despite the very challenging conditions in today's market, we remain committed to those goals and will continue each quarter to update the market as we progress. We outlined 3 areas that will be priorities towards achieving our objectives. First, strengthening the competitive position of our portfolio. We need to be a leader in cost, operating, and financial performance metrics, and need to make necessary changes to the portfolio to achieve these objectives. One of our key philosophies is that each asset needs to generate cash back to the business. We announced the decision to indefinitely idle our Gallup and Martinez refineries. Closures as a result of the tough refining business climate ahead of us have been amplified by the impact of the pandemic. At Martinez, we are evaluating repurposing the refinery towards the production of renewable diesel. The facility has the ability to provide up to 48,000 barrels per day of renewable diesel. We have the unique opportunity to take advantage of the strong set of logistics assets for the area and also have 3 significant processing units that are an ideal fit for making renewable diesel. These advantages should drive significantly lower capital requirements compared to greenfield investments, and if pursued, enable initial production as early as 2022 with the option to ramp up from there. Second, improve our commercial performance. That entails leveraging our extensive integrated footprint to make improvements in how we select and source raw materials and how we place our products into the various sales channels and geographic markets. Our intent is to keep an eye on what we don't control in terms of the market, but really focus on what we can control against any macro environment. This quarter, I've been encouraged by the team's quick progress, shifting our mindset and actions. And third, focus on lowering costs in all aspects of our business and to be disciplined in every dollar spent, addressing risk and return to the business without losing focus on safety and reliability. We're confident we will meet the $950 million expense reduction target for 2020, and in addition, we're on track to lower capital spending by $1.4 billion in 2020, as we previously announced. We are also implementing plans to structurally lower costs as we look out to 2021 and beyond. Overall, as I stated previously, we recognize that we're in a return to capital business, and we need to have an asset base and cost structure that works across all cycles. we're focused on becoming a lower-cost, disciplined company that can endure the volatility inherent in the sector, creating value for shareholders that is structural and long-term in nature. On slide 5, I would like to share some of the progress on the tactical initiatives we outlined last quarter, focusing on improvements to our liquidity and actions we have taken to carry our company through the current down cycle. In late April, we issued $2.5 billion of senior notes and used the proceeds to pay off a portion of the borrowings that were made on our revolver in March and early April. Also in late April, we enhanced our liquidity position with the addition of a $1 billion 364-day revolver. We have even more borrowing capacity available to us now than we did at the start of the COVID-19 pandemic, with over $7.5 billion of financial flexibility available for MPC. At this point, I'd like to turn it over to Don to review the second quarter results in more detail.
Thanks, Mike. Slide 6 provides a summary of our second quarter financial results. This morning, we reported an adjusted loss per share of $1.33. This adjustment reflects a $1.5 billion pre-tax lower of cost or market inventory benefit. Adjusted Ebitda was $653 million for the quarter. Cash from operations before working capital changes was a cash source of $172 million. Our dividend payments for the quarter were $378 million. Slide 7 shows the sequential change in adjusted Ebitda from first quarter 2020 to second quarter 2020. Adjusted Ebitda was down approximately $1.2 billion quarter over quarter, driven primarily by lower earnings in refining and marketing. Lower throughputs and crack spreads in the second quarter due to the substantial demand destruction from the COVID-19 pandemic significantly impacted R&M earnings. Second quarter results also included net adjustments of approximately $1.4 billion, primarily related to a lower of cost or market inventory benefit, bringing net income for the quarter to $9 million. Moving to our segment results, slide 8 shows the change in our Midstream Ebitda versus the first quarter of 2020. Midstream Ebitda remained relatively stable quarter over quarter, despite challenging market conditions. Ebitda decreased $51 million versus the first quarter, primarily driven by impacts from the COVID pandemic. These results highlight the stability of the midstream segment's fee-based earnings and our recently implemented cost control measures. Slide 9 provides an overview of our retail segment. Second quarter Ebitda was $626 million. Due to demand destruction associated with COVID-19, fuel volumes were down approximately 25% from first quarter and approximately 37% year over year. Retail margins of nearly 40 cents per gallon helped support relatively stable quarter over quarter segment earnings, despite the decline in fuel volumes. We saw merchandise sales improve from first quarter, supported by seasonality. Same-store merchandise sales only decreased 4% year over year, despite stay-at-home mandates and the significant fuel demand pressures of the quarter. Within merchandise, declines we experienced across food and soft drinks in the quarter due to lower in-store traffic were largely offset by increased demand for alcohol and cigarettes. Same-store sales, including cigarettes, were essentially flat to last year. Slide 10 provides an overview of our refining and marketing segment. Performance in this segment reflected 3 full months of demand destruction associated with the COVID-19 pandemic. Second quarter adjusted Ebitda was negative $1 billion, a decrease of approximately $1.2 billion versus the first quarter. Margins in all regions were under considerable pressure compared to first quarter 2020. Refining and marketing margin was down over $4 per barrel from first quarter, and utilization was down 20%. Despite these challenging conditions, the team did an excellent job managing costs through the quarter. Slide 11 presents the elements of change in our consolidated cash position for the second quarter. Cash at the end of the quarter was approximately $1.1 billion. Operating cash flow before changes in working capital was $172 million in the quarter. Changes in working capital was a $366 million source of cash in the quarter. We saw crude prices increase in May and June, partially reversing some of the previous working capital cash use impacts. Slide 12 highlights the progress we are making to lower our cost structure. We provided guidance for refining operating costs in May for the second quarter, which included assumptions around targeted cost reductions and throughput of about 2.1 million barrels per day. The guidance of $6.90 per barrel was based on forecast operating expenses of about $1.3 billion, approximately $300 million lower than the first quarter results. Second quarter results show that operating expenses came in $64 million better than the already lowered guidance, demonstrating the disciplined approach we are taking with every dollar spent. On slide 13, we highlight our liquidity position at the end of the second quarter. Our credit facility availability increased to approximately $7.7 billion at the end of the quarter. As a reminder, in late April, we issued $2.5 billion of senior notes. Net proceeds were used to repay a portion of the amounts outstanding on the 5-year revolving credit facility. In June, we fully repaid that credit facility. We believe we've positioned the company with ample liquidity to successfully operate in the current business environment. On slide 14, we provide our third quarter outlook, which includes estimated throughput at our facilities based on projected regional demand. We expect total throughput volumes of just over 2.3 million barrels per day, a slight increase from total second quarter throughput. Planned turnaround costs are projected to be $270 million in the third quarter, which includes hydrocracker turnarounds at our Los Angeles facility, a full plant turnaround in Kenai, and catalyst changes at Galveston Bay and Garyville. Total operating costs, including major maintenance, are projected to be $6.50 per barrel for the quarter, and distribution costs are projected to be under $1.3 billion. For the retail segment, we expect fuel volumes of approximately 2 to 2.2 billion gallons and merchandise sales in a range of $1.7 to $1.8 billion. Fuel volumes have begun to recover from second quarter lows. However, there is some demand uncertainty from actions currently being taken to address resurging COVID-19 case rates. Consistent with the prior quarter, we expect merchandise sales to remain relatively resilient. With that, let me turn the call back over to Mike for some closing remarks.
Thanks, Don. I'd like to take a moment to provide some comments on our responsibilities around corporate leadership. We recently published our 2019 sustainability report, highlights of which can be found on slide 18 in the appendix. The report is greatly expanded this year in terms of content and disclosure and outlines our commitment to provide information consistent with the many reporting frameworks that are influential in the investment community. As such, the report summarizes our comprehensive efforts related to environmental, social, and governance aspects of our business. On that note, I wanted to touch on recent events that have impacted many of the places where we live and work. At Marathon, we are committed to fostering a diverse and inclusive workplace and to partnering with organizations in the communities where we operate to encourage acceptance, tolerance, and unity. Like many companies, we are charting a path towards greater understanding, listening, and open dialogue, and we are firmly committed to continuing to make progress in this very important area. With that, let me turn the call back over to Christina.
Thanks, Mike. As we open the call for your questions, as a courtesy to all participants, we ask that you limit yourself to one question and a follow-up. If time permits, we will re-prompt for additional questions. We will now open the line to questions. Operator?
Thank you. We will now begin the question and answer session. If you have a question, please press star then one on your touch-tone phone. If you wish to be removed from the queue, please press star then two. If you are using a speakerphone, you may need to pick up the handset first before pressing the numbers. Once again, if you have a question, please press star then one on your touch-tone phone. Our first question will come from Neil Mehta with Goldman Sachs. Your line is open.
Thank you, and congratulations, Mike, Don, Christina, team, on the transaction. The first topic is around cash flow. Can you talk about the pieces that go into the tax number that bridge between $21 billion and $16.5 billion? And with the cash, what's the framework around allocating cash, recognizing we'll get more color around this later, and thoughts on debt reduction versus buybacks versus special dividends? And then I do have a follow-up.
Hey, Neil, thanks for the comment. First of all, before answering the question on use of proceeds, let me just make a couple comments on the deal itself. First of all, we looked at a lot of different structures and a lot of different options and came to the conclusion that this deal creates the most value and the most certainty for our shareholders. And I just want people to recognize, Speedway is a leader in the company-owned, company-operated business. And 7-Eleven, which currently has a larger franchisee model and a smaller company-out footprint, will now be able to look to the Speedway employees and benefit from Speedway's expertise in the company-owned model. And the combined entity will be that much stronger going forward. So I think that's important to recognize as part of this deal. Okay, on use of proceeds and capital, I'll make a few comments, and then I'll let Don also touch on the topic. First of all, I've stated previously many times and in prepared remarks that I believe this is a return of capital business. And I've made a statement that we have three key initiatives going on, optimizing the portfolio and evaluating assets for free cash flow generation, improving our commercial performance, and reducing cost. And I think, all of these are aimed at returning more capital to shareholders. And this transaction is no different. We expect two primary uses of proceeds. One is to defend our investment-grade profile, and Don's going to talk about that a little more, and then returning capital to our shareholders. And with respect to return of capital, we know this is an important component of the value realization, and we are committed to it. The issue we have right now, though, if there wasn't a global pandemic and a global recession in progress, and we had a much clearer picture of refining supply and demand going forward, it'd be much easier to give a little bit more detail. But between now and the closing date, we're going to continue to evaluate the most efficient and effective means to accomplish it, and we'll provide more specifics at the time of the transaction closing. But let me let Don give a little bit more comments related to this positioning.
Yeah, Neil, I guess, you asked a couple questions. Maybe let me first talk a little bit about, because I think it's important around our consideration of use of proceeds. Let me talk a little bit about, how we think about defending our investment-grade credit profile. So maybe backtrack just a month or two. When we had our first quarter earnings call, liquidity was probably top of mind, and I think, we took some very proactive actions to make sure that we had, addressed that issue. And as I mentioned on our comments now, we have $7.7 billion or so of available liquidity, so we feel like we're well-positioned, well-situated going forward. As we think about, as we look ahead, I guess, that we believe that an important part of our capital structure is an appropriate level of debt. We don't think it's efficient in this environment to be underlevered, but we also want to make sure that we're defending our investment-grade credit profile. And as I think about defending our investment-grade credit profile, no one metric or factor drives that consideration. We'll look to a number of inputs that include, obviously, the lost Ebitda from the Speedway sale, but we'll also consider the steady cash flows we have from our ownership interest in MPLX, our views around mid-cycle and through-cycle Ebitda, the size of our committed credit facilities, which are very significant, and the cash we currently have on our balance sheet, which is $1 billion, our dividend policy going forward, and various metrics such as debt to Ebitda and debt to capital. But I think that, all of those things will be a part of the consideration. And as Mike mentioned, the unprecedented macro environment makes it difficult right now to be more specific. You did ask a question about tax, and so on that particular topic, our tax basis in the assets that we're selling was, just under $4 billion, and so the after-tax proceeds that we're showing in the release, the $16.5 billion, is really predicated on that tax basis.
That's very clear. The follow-up is bigger picture question, which is, in many ways, you are losing your most valuable business and you're monetizing it at a great multiple. But can you talk, Mike, about how you think about value creation for here? And what you're left with is MPLX and a refining business. How do you drive value out of those two business segments and set up the company over the long term without the stable, ratable cash flow of Speedway?
Yeah, Neil, that's a good question. Let me make one comment on the Speedway deal relative to that is, we still believe we're going to get the benefit of integration. That's not lost because of the supply agreement that we have and the fact that we'll, continue to be using our logistics assets. But to your broader question, we still have, a lot of work to do in the three areas that I keep mentioning. So strengthening the portfolio, is going to continue to be a theme that you'll hear from us over time as we continue to look at our assets. We're just getting, into the midst of improving our commercial performance, so you'll hear more about that over time as well as the cost structure. We've given, some early indications for 2020 to lower our, cost structure by about $950 million, but we have more work to do in that area. So you have a real good question, where do we go from here? And I just ask you to, keep thinking about those three priorities. We're going to continue to report on those. We're certainly not done from this standpoint. We've looked at obviously a couple assets in that regard, and obviously getting the Speedway deal done was a high priority for us. And I think it does put us in a unique position, to return capital to shareholders, as Don mentioned, to get the balance sheet in the right order. So I think we're in a good position relative to, the environment that we're in. And we expect that to stay challenged for some time, although, we're optimistic that, just like all these cycles, we'll get out of it at some point. And we're seeing a slow recovery, which is headed in the right direction, but we're just anticipating, that it could take a while to get back to normal.
Thanks, Mike. Appreciate it, team.
You're welcome, Neil. Thanks for the question.
Thank you. Next, we will hear from Doug Leggett with Bank of America. You may go ahead.
Thanks. Good morning, everybody. And Mike, let me add my congrats to that great multiple on Speedway. So I have two questions, if I may. The first one is actually about Martinez and Gallup. I wonder if you could just walk us through the process that got you to the conclusion that you came to. Was there an option, for example, for a sale? Is it an inventory liquidation event that comes out of this? And maybe if you could frame for us what other assets in the portfolio today don't meet that criteria of generating positive cash flow.
Yeah, Doug, also a very good question. I'll start with Gallup. And like I said in my prepared remarks, these are very difficult decisions for us to contemplate during some really tough times. I mean, COVID has had an impact on many people in many different ways, but it's obviously, had a real strong impact on our business and the business and climate that we're seeing going forward, especially with refining supply and demand. And obviously that's more weighted towards the demand side. But anyway, to answer the question, we had a unique niche in the marketplace there that's essentially been competed away over time, so that it's much more difficult for a small refinery to be successful. But to answer your direct question, we did look to sell the asset. We ran a process, but unfortunately we did not get something that we could execute on. So absent the process being successful, we thought the next step was to put it in an indefinite idling position, but still keep the logistics assets, active so that we have some other opportunities from that standpoint, and then we'll see how things play itself out. On Martinez, we did not look at a sale, to your question there. We're pretty excited about the opportunity of reconfiguring the asset into renewable diesel. We got some more work to do there, and I know we have a lot more detail, but I do want to give you at least the direct answer to your question as to whether we looked at sales. We did at Gallup. We ran a process that wasn't successful. We did not at Martinez. So hopefully that answers that question.
It does, and I appreciate the candor. Maybe I don't know if you want to take the next one as my follow-up as well, Mike, or if you want to throw it to Don, but I'd like to preface the question, but I'm just taking a look at MPLX's stock price or unit price since you did the IPO, I guess about 7 or 8 years ago, and it's still trading below that level. I realize the MPLX process is done and dusted, so to speak, but when you look at the outstanding equity and the amount of cash you just brought in, why would it not make sense to buy in the balance of MPLX, given that the incremental cost base still seems to weigh on your refining valuation? I'll leave it there. Thanks.
Yeah, Doug, it's another good question, and as you referred to our midstream study, whether it's bringing it all in or actually looking at the RLFD, refining logistics and fuels distribution, we went through a pretty exhaustive study, as you're aware and you referenced, and the bottom line is, we came to the conclusion, that we didn't want to buy in a cash stream that we were already getting with respect to the RLFD. Marathon, has a unique position where we're receiving about $1.8 billion in distributions from MPLX, and RLFD is about $1.4 billion of Ebitda. So, again, I'm saying we came to that conclusion of why would we buy in that cash stream when we're getting it essentially via distributions, and instead use that capital, which would be north of $10 billion in return to MPC shareholders. So that's where we came out on the subset of it. As far as all in, at the end of the day, there is, some amount of cash flow that goes to partners on the one side of the fence. On the other side of the fence, we'd be paying tax to a certain extent, depending on, where we think the tax rates will be going forward. So at this point, we do recognize and we are frustrated at the level of, equity value that MPLX has. At the same time, we felt or continue to feel that, the amount of capital that would be needed to do that at this time makes more sense to return to shareholders as opposed to not. And obviously we've concentrated a lot on the Speedway unlock of value, and that's kind of where our head is for right now. And as I mentioned, and Don commented as well, is we're going to be doing a lot of analysis between now and the close to look at what's the best use of proceeds, but the highlight priorities are, the balance sheet and returning capital to shareholders.
All right. Appreciate the answer, guys. Thanks.
You're welcome, Doug.
Thank you. Our next question comes from Roger Reed with Wells Fargo. Your line is open.
Hey, thank you. Good morning.
Morning, Roger.
I guess maybe to follow up on kind of the whole restructuring and slide 4, where you've got the three kind of, I guess, guideposts, I'll call it. Where should we think about where you are in the overall sort of evaluating the company, potentially restructuring the company? And this is going to get back to some of the questions already been asked. Do you buy an MPLX? Do you want to, buy in a bunch of shares, change the dividend, et cetera? But I'm just curious because you couldn't have known for certain about getting a sale of retail done until obviously you signed the papers, even if the cash is still a few months away. But now that you have certainty of that, how does that maybe affect the way and where are you maybe in terms of progress in doing an evaluation throughout the company on both sort of a current COVID basis and then on a maybe call it more of a mid-cycle, kind of 21, 22 outlook standpoint?
Yeah, Roger. So like you said, on the three initiatives, we still have a lot of work to do on the portfolio. To your point, we could not be assured that we would get this deal done. We were very optimistic because we believe Speedway is a really attractive asset out there. We did get significant interest, and I think we concluded the deal that's in the best interest of ourselves, Speedway and 7-Eleven. As far as the portfolio, though, we still have a lot more work to do, both on the refining side and the logistics side and the G&P side. I mean, there's a lot of activity going on, and the best I can give you is over time we'll continue to disclose how we're feeling about certain things. We don't want to get ahead of ourselves in the market, but we want to get to a portfolio. Our goal is to get to a portfolio that generates significant free cash in any environment. And for me personally, I'm a protect the downside. So knowing that we're going to have these down cycles, we want to make sure the portfolio is very resilient during those times. As far as the other areas, like I said, we're just starting to make some moves in the commercial area, and that's the one area that I'm probably going to be the least disclosing about just because of the competitive nature. And then the cost structure, I think, just keep an eye out for each quarter as we continue to progress. My personal style is not to, put out a big number and then, try and track against it. It's more of a try to have continuous improvement and continuing to lower our costs in a lot of different ways and change, our philosophy on cost and change our philosophy on capital discipline. So each of those, I think, Roger, each quarter we'll be able to talk a little bit about how we've made progress in each of those areas. And then hopefully you'll get to see over time, how we're looking to maneuver the company. I hope that makes sense to you.
It does. You're gonna make us wait. That's always the hardest thing for us. As a follow-up, and I know, Don, you've already tried to address the tax issue, but we've been getting a lot of questions in on it. I was just curious, the other refiners, for the most part, have discontinued ETR guidance because the current environment and the CARE Act has some real impact. So I was just curious, as we think about, the $21 billion, the 16.5 net, are there other things that may flow through here in coming quarters, whether it's going back and capturing prior profit, tax payments, or something else that might allow you to whittle down the tax impact on the sale?
Yeah, Roger, in connection with sort of the effective tax rate, I mean, 2020 was an unusual, or is going to be an unusual year because, as you look at least our book income, we had significant charges related to goodwill, and it has limited deductibility. So, our first quarter and then year-to-date effective rate, was in the sort of middle teens as a percentage, really driven by that. What we spend all of our time doing is really looking hard at our cash tax position. And, as we disclosed in the first quarter and as we will disclose again in our second quarter 10-Q, we believe that that as a result of the CARES Act, we're anticipating that we will have net operating losses in 2020 given the environment and also given the significant capital expenditures that we've made in the past where we get to take the depreciation deduction when assets are placed in service. So we expect that there will be a significant NOL, and the CARES Act provides that you can carry that back up to 5 years, and we would expect to carry back NOLs into years that, given that 5 years, that have a 35% tax rate. So, we think that's a good thing for MPC. Our plan would be that we would work on getting our 2020 tax return filed as quickly as we could in 2021 to be able to affect that NOL carryback and the refund that would be associated with that. With respect to the sale of Speedway, obviously, we will continue to evaluate that, and we will look for ways to, best optimize the tax position. But we thought that it was appropriate for purposes of this announcement to give you, the sales price minus the basis times, what we believed was a normal tax rate at a relatively statutory rate. Okay,
just one minor follow-up on that. In terms of when you file the 2020 return in 21, timing on a refund, that's just my last data point.
we believe that happens relatively quickly, but who knows what the world looks like in 2021 if people are still working from home or still, in their offices, Roger. But, we believe that's a relatively rapid, a rapid transaction, a rapid result, if you will. So, we're going to push really, really hard to get our return filed as quickly as we can. And then we would expect that the refund would manifest itself relatively quickly after that.
Thank you.
Thank you. Our next question comes from Paul Cheng with Scotiabank. Your line is open.
Thank you. Good morning, guys.
Morning, Paul.
My two questions, if I could. I think earlier that you say that it doesn't make sense for you to buy in for the remaining of MPLX. So is the company consider that with far more flexibility with the cash infusion, whether that you may reopen that you do you want to spin off totally the MPLX? Whether that this is a consideration or that you still conclude after the exhaustive evaluation that you're just going to keep the structure as it is. The second question is related to the Golden Eagle, whether not shutting it, can you still run the renewable, or that to run the renewable you need to shut it? And in terms of the renewable, how big is a business that you want that in the long haul for your business? Take into consideration, on one hand, current margin and return are very good, but on the other hand, the barrier of entry is low, and the margin and the demand are essentially government mandate. So want to see how you view that business long haul. Thank you.
Okay, Paul. So on the first one, we don't have any other comments other than, as I mentioned, we're going to do a lot of analysis. We have some time to look at what's the best thing to do with the proceeds. But I do want to leave everybody with the priorities that we have are, the balance sheet and returning capital. So one of the obvious things that we stated from the beginning with Speedway was we did want to unlock that value realization, and returning capital is a high priority. So I don't want to comment on anything other than those at this point. On your questions on Martinez and renewable, I'm going to turn to Ray in a second, but let me just give a couple opening comments. So, first off, I think Martinez is in a unique, set of circumstances relative to the hardware that exists at the facility, and I'll let Ray talk about that. We are a believer, that the, renewable, positioning is going to be beneficial to us because it aligns with California's low carbon fuel standards. We've also stated MPC has greenhouse gas reduction targets that we want to accomplish, throughout the decade. So strategically, this fits with where our thinking is. And I would just give you a little bit of framework as we think about capital investment there. And this was the harder decision. The expected capital that, we're going to put in for the first phase, assuming we go with this, is about the same amount of capital that we would put into a planned turnaround for the facility. So we really hit a decision point and decided to pivot and look at renewable diesel production as opposed to refined product production. So that's kind of the decision tree, if you want to call it that. There's a lot of details that go into the analysis. So I'm going to let Ray give you a little bit more detail so you understand some of the specifics around Martinez, its own specifics about the facility.
Hey, thanks, Mike. Paul, just want to give you a framework a little bit that we've actually been looking at Martinez for a long time, essentially ever since we merged with Endeavor. And early on, we evaluated what you suggested, co-processing for renewable diesel, but those economics weren't nearly as strong as the conversion that we're looking at right now. The key item, and Mike just hit on this, is with the refinery continuing in its current form, is that it has an extremely high cost structure, and then we have the near-term headwinds with a heavy turnaround spend in the coming year. So we believe that transitioning Martinez to a renewable diesel plant ultimately creates value for our shareholders, and there are certain unique advantages for this site. A Martinez renewable diesel facility can provide up to 48,000 barrels per day of capacity, and we expect the initial production could be online in 2022 and ramping up from there. We are continuing to evaluate in more detail, but the initial analysis looks extremely promising. Martinez's current complexity presents a capital-efficient project for us, given that there are 3 high-pressure hydroprocessing units. Retrofitting these units will allow for renewable diesel production equal to about 1/3 of the current refinery's nameplate crude capacity. There are also the existing hydrogen plants, power generation, and extensive inbound and outbound logistics that are all needed to produce renewable diesel. So our intention is to pivot to the production of higher value, low carbon intensity diesel for California. Martinez produces about 54,000 barrels per day of ULSD at full utilization, and the conversion would produce up to 48,000 barrels per day of renewable diesel. I want to emphasize that this is not a grassroots facility, so there is an element of speed of conversion. We believe that we have an early mover advantage, and we believe that there are opportunities for meaningful partnerships with feedstock suppliers. Now, we fully understand that the drivers for the economics of this project are not our typical refinery project, that there are regulatory drivers, but at the end of the day, with the unique advantages for Martinez that I talked about earlier, we're just really excited to take this evaluation further.
Wade and Mike, can you give us some idea that for the company as a whole, long term, how big a renewable diesel business that you want to be, or you're willing that to get? Is there a ceiling, or you think that no, there's really no ceiling? It depends on the opportunity set. And also that after the Speedway sale, who is going to keep WIN? That's it for me. Thank you.
Yeah, Paul, it's Mike. So I don't think we have a targeted number at this point, but I do want to say that we're going to continue to look at the portfolio and make decisions as we go along. You know, Martinez, our priority, as Ray said, is going to be evaluating the different phases here. The other thing I would like to add, for those who've known me in the past, I believe joint venture arrangements can be very successful as well when you get into these types of deals. So, managing the capital and achieving a better overall outcome for all parties is something else that we're looking at very hard here. So we're evaluating that approach in general. I think at the end of the day, we think there's some real, uniqueness here that should be beneficial. Ray gave a lot of the technical stuff. I say on the commercial side, we're going to talk a little bit, about, JV opportunities in the future. Managing the capital is one of our, main criteria. We want to have strict discipline. So that's another important piece of this. So I just wanted to make that comment. And I'm also going to let Brian make a comment as well.
Yeah, Paul, to your question, the last question that you snuck in there regarding the RIN as it relates to the Speedway separation, just wanted to address that real quick. So I think the first thing to understand and appreciate that we've always had a market-based philosophy and approach to pricing with Speedway. So as a result of the separation, fortunately, due to that historical philosophy, there's really no step change or movement in value shift. But fundamentally, MPC will be the blender of record in all transactions. So we will possess the RIN and retain the RIN. As it relates to the value of that RIN, that's always driven by market specifics, which is individual market by market, and the agreement fully contemplates that. When you talk about a long-term agreement like this, we have to make sure that it's resilient over time, and the agreement fully contemplates this for RINs or anything else, frankly, in the future. So, that's the way it's going to be handled in the agreement. So, just wanted to make the point and underline and underscore that there is no value shift whatsoever as a result of the transaction on RINs.
Thank you.
Mm-hmm.
Thank you. Next, we will hear from Manav Gupta with Credit Suisse. You may proceed.
Hey guys, my question is on the crude sourcing side. During 2Q, medium sours were very tight, but as we move into 3Q, we are seeing Russia and other OPEC countries raise those volumes. So do you expect more discounts on medium sour crudes going in 3Q, which could help your Gulf Coast results in 3Q?
Hey, Manav, it's Mike. So Rick's not here today, so I'll take a shot at that. He's out of the office today. I mean, in general, we think directionally, the crude market is going to hopefully move towards us with increased production. As you stated, we're going to have, a little bit of a recovery in the production side of it, which hopefully will put some pressure on differentials. Right at the moment, as you're very aware, refining, crack spreads are still very weak, and it's not been a good environment for refiners. But, as I mentioned earlier, we're optimistic but cautious. As recovery, continues to progress, hopefully we'll get to see a recovery in refining margins, which we haven't seen yet. And as crude production continues to progress, to your point, then hopefully we'll get to see a little bit more, opening on those spreads. I would, Manav, this might be a good opportunity. Let me let Tim and Brian make a comment on where we think we are in demand recovery. So give you a little bit of flavor of how we're seeing the demand side. So Tim, why don't you start with gasoline, and then Brian can finish up with the portfolio.
Yeah, you bet, Mike. As Don referenced, we've seen a really continuing amount of recovery in gasoline demand since the early April lows in really all regions of the country, as many of the states have reopened, with probably the greatest strength in the Midwest, really through the second quarter. Recovery trends nationwide have slowed more recently, with system-wide weighted same-store sales volumes currently down sort of 10 to 15% compared to last year, with the East Coast about 5% behind the Midwest, and the West Coast another 5% behind that. So we're, as referenced earlier, we're watching carefully the latest COVID case escalation in multiple regions and the potential for states or counties to back up on their reopening plans. Schools going back to in-person is a significant wild card on the demand side, as students at home will have some consequence for the ability of parents to return to their workplaces and getting people back on the road. For what it's worth, we also think the increasing requirements for masks nationwide is a positive for demand, as it facilitates increased mobility with more things able to be open, which potentially gets people back on the road to a meaningful extent. We'd much rather see people out on the roads with masks than at home without them. With that, I'll turn it over to Brian for diesel and jet.
Yeah, thanks, Tim. So to continue on with demand, Manav, I can kind of talk across our entire book. So to Tim's point, we see, the exit rate for July is down about 10 to 15% overall. So I can echo what Tim's saying. That just a couple of regional notes. The one, I guess, downside note on a regionality is in the Southwest. So with the resurgence in cases of COVID in the Southwest, we have seen a weakening here over the last several weeks in that particular region. On the bright side, the Midwest and Atlantic Coast both recovered, and they're down roughly 7% year on year across the total book, which is a really good sign for the Atlantic Coast, as everybody knows that we're pretty hard hit up in the New York, New Jersey marketplace. On the diesel side, we hit our low point, just as a reminder, in the early to mid-April. We were off about 22% year on year. We exited July off about 10%. And to Tim's point on demand profile, we have seen since the 4th of July kind of a sideways motion as it relates to demand, but it's been pretty stable over that period of time, but somewhat in a plateaued manner. The downside regionally, the Great Plains is off 15 to 20%. A lot of that has to do with the heavy demands up in the Bakken area that have curtailed as a result of drilling activity up in that market. And then the upside regionally in Midwest is about 5% off, and we're actually up in the Southeast year on year on the distillate side. Closing out on jet fuel, the second quarter we were off roughly 34% year on year, a pretty big outperformance relative to the market. A lot of that has to do with our sales mix. We're heavily levered to cargo sales, which saw a really strong resurgence really since the COVID outbreak, and even before that with online retailing really driving a lot of the demand in the Midwest and also up in the Alaska market. July, we're actually down year on year in the low teens, so really strong performance by our aviation team. that's really starting to see the fruits of the combination commercially with the Endeavor portfolio and MPC coast to coast. A lot of the jet buyers, they're levered across not only the U.S., but just globally. So really been able to create richer relationships there to drive incremental capture of market share overall. Really the outlook on August is pretty flat to July. We expect to be some downside to that based on the resurgence in both cases, stay-at-home orders as well as quarantine. And really the thing we're watching right now as we look ahead to September is what is demand going to look like in September, given that a lot of schools are not returning to normal, people are working from home. So there is definitely a pent-up demand of folks wanting to move around. So, it's a bit of a wild card of what demand's going to look like in September. You can make as good of an upside case as a downside case, so we're watching it closely.
And Manav, just to circle back to crude, I know you asked about the Gulf Coast, but hopefully, Canadian differentials will start to widen a little bit as more production comes online into that market. And then on the West Coast, we're starting to see, some foreign economic alternatives like Russian grades, Brazilian grades, et cetera, et cetera. So it's been pretty tough sledding for refiners, and I'm hoping we get a little bit of margin improvement with some of the adjustments of crude production coming on.
This is very helpful, sir. I had a very quick follow-up on DAPL. I think you're moving about 50,000 on DAPL to your Midwest and Mid-Con refineries, but I think there are three offsets, Anacortes, St. Paul Park, and Mandan. Can you split up your Bakken usage between DAPL and non-DAPL? I'm just trying to understand, in case DAPL does go down, are there enough offsets to that 50,000 barrels so you actually may not see an earnings headwind on the refining side?
Yeah, Manav, that's accurate. So, we have a bunch of other alternatives other than DAPL as far as supply. So if DAPL were to not run, we think we have enough alternatives on the supply side. So I think you're right on with your statement. One comment I would say, though, on the logistics side, with respect to, DAPL as well as, another pipeline up in that area, the High Plains Pipeline. I mean, MPLX is a 9% owner in DAPL. And then the High Plains Pipeline, if that were to shut down as well as a result of the recent, discussions about, the BIA looking to have it shut down, I'll give you a couple comments that I think would be helpful to clear in the market. Number one is, we believe on the BIA that, an appeal has been filed at this point, which triggers an automatic stay of the shutdown. So we don't think there's anything in the short term because there is an automatic stay. And then we'll continue to try and advance that discussion to a good conclusion for all parties. On DAPL, obviously Energy Transfer is taking the lead in that discussion from the legal standpoint, et cetera. But both of those together, if they were both to shut down on the logistics side, we think the impact to us would be less than $100 million if both entities were to be down. We don't think that's the likelihood case, but I just wanted to give you a little bit of the logistics side of it. And then to your point on the MPC supply, we think we have enough alternatives that, Mandan would be supplied adequately as well as our PADD 2 refineries.
Thank you so much for taking my questions.
You're welcome.
Thank you. Our next question comes from Benny Wong with Morgan Stanley. Your line is open.
Hi, good morning, everyone. Thanks for taking my question. My first one was wondering if you can provide some color or details around the 15-year supply agreement with 7-Eleven. Wondering if there's a value you would assign to it, and maybe give us a sense of the opportunities of growth in terms of areas and size there.
So I'll give some comments and then I'll let Brian add. Benny, I mentioned earlier, one of the big benefits that we see in the agreement is we maintain, a lot of the integration benefit that we see, as part of our portfolio. So I mentioned earlier, it's about approximately 8 billion gallons for 15 years. So it's a long-term relationship that we're looking forward to with 7-Eleven. And a lot of the integration benefit that we have is providing the logistics service and providing the transportation and trucking services. So, we're going to continue to provide those services for 7-Eleven. So, there'll be a benefit to us as far as using, our logistics assets, using our trucking services trying to give them the utmost in terrific service. So I think it's a win-win for both of us. We're going to capture the integrated value as far as the logistics and the supply, and in 7-Eleven, obviously, we'll capture the margin in the retail business going forward. Another important point is that $7.7 billion holds steady for the whole 15 years. So it's a very long-term relationship. So that's one component. And the second component is we plan to work hand in hand with 7-Eleven as they grow out their portfolio. They've had a stated goal to expand to about 20,000 stores, and so we have a second agreement with them that I'll let Brian comment on, which is to continue to supply them beyond the existing Speedway situation.
Yeah, thanks, Mike. Yeah, so Benny, it's a little tricky to talk about the supply agreement commercially for obvious reasons, but maybe I'd kind of underscore a couple of the guiding principles and tenets to it and hit upon what Mike already mentioned. Really is, it's important to know we had a market-based philosophy, so it's very difficult and tricky to develop a long-term supply arrangement, but we think we've done it. We think this is a really good, solid relationship that's a win-win for both parties. If you think about the history of the Speedway portfolio, literally growing up over decades in and around the infrastructure, so it's important to us to preserve the integration value operationally associated with that, which we've done so in the contract. At the same time, providing a really compelling, supply operationally as well as commercially for 7-Eleven in the transaction. So, we think going forward, it's really set up well for both sides from a win-win perspective. And then, Mike, from a growth perspective, historically, we haven't had, I'd say based on their scale, 7-Eleven, haven't had a huge supply relationship with them. So we think there's opportunity there, especially across the broader platform that we now have coast to coast, to work closely together to find more opportunities. So we think we've started down the right path. We think we've got the commercial construct to get there. And we're excited about the prospects of going forward once we get to the closing table to drive incremental value, not only for MPC, but across both sides of the table.
Great, thanks. That's very helpful. My follow-up question, a follow-up on your decision on closing Martinez and Gallup. Just wanted to get your thought on the impact, especially Martinez on PADD 5, when we get back to more of a normal environment. Should we expect that region to flip to be more an importer of product, and what you think that potentially does to the margin volatility in that region? And also wanted to get a sense in terms of the change in cost structure it brings, and if you think how much the price improvements from a tighter supply might bring to your other assets and potentially offset the normal contributions from these assets.
So Benny, I'll let Brian make a comment on the balance, and then Ray can make a comment on the cost structure.
Yeah, Benny, as it relates to the West Coast balance, I think, taking Martinez down is certainly directionally helpful for the balance, and that's an obvious statement. Hard to predict, though, going forward what that actually looks like as we continue to trend out of COVID. But we've been able to optimize and resupply within our network as well as with some of our trade partners in that marketplace. So, directionally positive. And then on the diesel side, I think Ray hit on it earlier. If you think about the mix of diesel production out of Martinez and what we're replacing with renewable diesel going forward, we think a one-for-one, but the key there is the renewable diesel is the demand element in the market. So it puts us in a really good position to not be the exporter in the market, to really help penetrate the market with what's being demanded out on the West Coast. So hard to know with complete certainty and to predict the future, but obviously we feel it's very directionally favorable for the marketplace.
Hey, Benny, this is Ray. I'll just talk a little bit on the cost structure. When I talked a little bit earlier about Martinez, I commented that it has a very high cost structure as a refined product refinery, so that going forward, we'll have a much more streamlined facility with the 3 hydroprocessing units, hydrogen plants, and so forth. So, we'll have a much lower cost structure on an OPEX standpoint, as well as I talked earlier about the CAPEX conversion. So that at the end of the day, we really feel that we'll have a cost advantage renewable diesel opportunity.
Great. Thank you very much, everyone.
You're welcome.
Thank you. Our next question will come from Prashant Rao with Citigroup. Your line is open.
Good morning. Thanks for taking the question. I wanted to follow up on the West Coast there. With Martinez going down, how do you think about the synergies in having sort of that coastal coverage north to south in PADD 5? Does that increase or change the importance of, or change the way that you think about, an Anacortes or Kenai, in terms of where that fits in the portfolio? And then, sort of related to that too, I wanted to ask a follow-up about some of the lower complexity, smaller refineries in the Mid-Con, but maybe starting on that West Coast synergy question, and then I'll wait for the follow-ups.
Yeah, Prashant, this is Brian Partee. Absolutely, yes. It's a fundamental shift not only in the West Coast balance, but certainly to our book. So as a result, it has a direct impact on how we think about medium and long term about the assets out in the West Coast. So, the West Coast system today is somewhat akin to what we're used to running in the Midwest with some of the flexibility we have between the plants. And this really just levers that and puts us into a different gear out West. Thinking about logistical assets, marine assets, terminal assets, and whatnot to be able to optimize the overall portfolio. We've always run the Midwest as a quote-unquote system, and the West Coast is largely functioning in a similar manner, and we see this directionally helpful to help us optimize the system overall. And we believe we've got the logistical capability to do that, and really feel like it puts us in a great position going forward.
Okay, great. And then just to follow up on some of the mid-continent, broadly speaking, assets, the less complex refineries. You mentioned that the Dickinson conversion is on target, and I think that had kind of been in the back burner in terms of market view or what we were paying attention to, and so it's good to get an update there. But when you look at some of the other assets that are there, you have a few other sort of lower complexity, so to speak, smaller refining assets in the Mid-Con. Where do you think that fits into the portfolio longer term? Some of those in terms of disposal versus conversion, or keeping them running as is. Just wanted to get some sense of your thought process around those.
Yeah, Prashant, like I said a couple times here, all the portfolio is going to be evaluated for what we think will be the best long term. You did mention, Dickinson, and I'll let Ray give an update so the market has a sense of where that stands. But I think, the takeaway should be, we've obviously looked at several of the assets we have. We have a lot more that we're having discussion about, and then hopefully, like I said, our goal is to get to a point where the portfolio, is able to generate cash in all environments. I mean, the one we're in right now is obviously, very difficult. But if we get back to a more normal environment, we want to have a portfolio that's, very resilient. So, Ray, you want to make a comment on Dickinson?
Yeah. Hey, with all the challenges that we've had with COVID, very, very pleased that we've been able to progress Dickinson right along schedule. And so at this point, we're still targeting before the end of the year to complete construction of 12,000 barrel a day renewable diesel facility and start up and have product by the end of the year. So that's still trending very well for us.
Okay. Thank you very much for the time.
You're welcome, Prashant.
And with that, operator, thank you. And thank you, everyone, for your interest in Marathon Petroleum Corporation. Should you have additional questions or would you like clarifications on topics discussed this morning, our team will be available to take your calls. Thank you so much for joining us. Have a good day.
Thank you. That does conclude today's conference. Thank you for participating. You may disconnect at this time.